Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0. News of the week, or as I like to call it, another episode of As the Housing Market Turns, or some of you guys say burns, crashes, whatever. As I always say, every week the information and data is picking up. Lots going on in real estate world and the housing market, so we got lots to talk about today. Just it is what it is, you know what I mean? So once again, fair amount of news going on. Today is Friday, June the 21st. I almost got the date wrong again there, so it depends on what I'm reading here. Simple as that. Today's topics, we're going to focus on the FOMC meeting and interest rates. NAR releases their May 2019 existing home sales report. Redfin releases their report as well too. Shifting trends in the real estate investment market, real estate and the S&P, student debt hitting another all-time high, and Freddie Mac announces a new mortgage program. It all ties together here anyway. So, but first of all, please take a second. If you're not a subscriber, just click that button and subscribe to my channel. It helps us grow, and I really would appreciate that. So thank you very much. All right. Also, many of you have reached out to me regarding real estate questions, buying, selling, real estate investment, discounted properties, whatever. I think I've pretty much responded to pretty much everybody that's inquired over the past couple of days by responding back to you, and let's see if we can set up a time to talk, etc. So I want to make sure you guys know that I responded to you. So let's set up some time and we can get talking today, the weekend, early next week, whatever it is. So again, I'm here to help you with any of your real estate questions on buying, selling, real estate investment, or whether you're looking to purchase a property for sub-retail, discount prices. Again, never pay retail is my motto. All right, so here we go. So let's talk about what's going on today. So of course, big news of the week was the Fed. They had their, I guess it's called the Federal Open Market Committee. They had a meeting this week, and guess what? Through those discussions, interest rates remain the same. The Fed did not raise interest rates, nor did they lower interest rates, and this is consistent with what they've said, that they were not going to change rates for 2019. So this should not come as a surprise to anybody. The Fed kind of even stated that, saying, this is what our policy has been. We're not going to really deviate from that unless we see some major shifts in the economy, which whatever their triggers are, they haven't quite seen that yet. And it's as they've planned, no rate increases for 2019. So I don't think, so that was obviously positive, but people were sort of looking for maybe a rate decrease. And I guess clearly for about 6 months, everybody was hearing that maybe we're going to have a rate decrease and, a cut at the next meeting. So basically, what it boils down to is that it's the media and analysts and economists suggesting this should happen and could happen. It wasn't the Fed saying this. So if people are disappointed, it's really investors in the media who were talking about rate cuts and stimulus. I mean, the Fed now is holding on its QT, which is quantitative tightening, as opposed to QE, which is quantitative easing. We've had 10 years of quantitative easing, so now obviously they're trying to slow things down or tighten things up with respect to what they're doing in the marketplace here. So again, as much as this was a highly debated topic, whether they would drop the rates to stimulate more buying and more production, it hasn't happened, so they're holding fast, and that's the news. As simple as that. All right. Existing home sales. So NAR, which is the National Association of Realtors, today, which is June 21st, released its, May 2019 existing home data. So I've got that right here. So their headline is, existing home sales rebounded in May, recording an increase in sales for the first time in 2 months, according to NAR. Each of the four major regions saw a growth in sales, with the Northeast experiencing the biggest surge in May. So I guess you could say that the existing home sales for all transactions, which include single-family homes, townhouses, and condominiums, and co-ops, jumped 2.5% from last month. So from April to May was a 2.5%, jump. So that's a positive thing for the housing market. So sales increased slightly from April 2019 to May 2019. So my opinion is that we're going to see the media jump all over this, and we're going to be talking about how the housing market's rebounded and using the great words that show growth and everything's good. But what is not really spoken of too often here is what happens year over year. So realize that total sales, however, are down 1.1% from a year ago. So sales compared to May 2018 are actually down 1.1%. So no growth on the annual side of things. So, of course, Lawrence Yun, NAR's chief economist, said that the 2.5% jump shows consumers are eager to take advantage of the more favorable conditions in the marketplace. The purchasing power to buy a home has been bolstered by falling mortgage rates, and buyers are responding. Okay, a 2.5% increase to me is not a resounding response, to be honest with you. And again, when you're looking at a 1.1 decrease compared to previous years, that's not a overwhelming response either. However, the median existing home price for all housing types was up to $277,700, which is up 4.8% from May of 2018. And this price increase marks the 87th straight month of a year-over-year price gain on the monthly basis here. So though inventory is up, the month's supply remains near historic lows, which has a direct supply and price. So this is according to Realtor.com, NAR, Lawrence Yun. So should demand along with an adequate inventory of affordable homes have pushed the median home price to a new record high. That's what it boils down to. So please realize that it's not necessarily the market responding, it's the lack of homes that are pushing prices up a little higher still. So that's the scoop there. And again, what I want to make sure that everybody understands is that we can see there's some trends happening here, and I want to go through them right now. So existing homes by sales by region, the West had 21% of the sales, the Northeast 13% of the sales, the Midwest 23% of the sales. Overwhelming was the South at 43% of the piece of the pie. So the South was the biggest generator of real estate sales for the month of May. If you want to look at some of the market conditions here, 32% of all sales were first-time home buyers. That's up 1% from the year before. Sales to investors were 13%. That's down from 14% the year before. Cash sales were 19%, and distress sales were 2%, which is down from 3% from the previous year. And they noted that less than 1% of the sales on the distress side were short sales. So short sales are making up less than 1% of all the real estate transactions across the marketplace, across the board in the U.S. here. Now, if you do look at their total existing home sales percent year-over-year change, you're going to see they just do a 12-month. I guess you say a 12-month chart here, and for the past 12 months, the year-over-year sales have declined. Whether it's 1%, or actually everything's pretty much almost 2%, or if not greater. But again, realize that as much as we have a month-to-month increase, that's not a year-over-year increase, and we're still showing the trend is less sales, less sales, less sales. So please, even though it was not as much less sales, it still is significant because it's less sales. And as I mentioned, we're probably going to see, and I've talked about this in previous videos with previous comments, we're probably going to see a little bit of an uptick now as this we have May, now June and July hits. We're probably going to see some uptick May, June, July, August with respect to sales activity, and then what I personally expect will happen, we'll see a slide right after that, and the drop will happen a little faster than we've seen before. That's my prediction. So sales by price range, and I want to point this out because when you take a look at the fact that our home sales, the median price has gone up again, so you look at going, well, if sales are decreasing in volume, and we know there's more inventory out there, and we know that sellers are offering less, there's more price reductions, whatever, how do prices keep increasing? Well, it's because because of a shift in where people are buying. So if you take a look at where they're buying, the 250,000 and above market accounts for about 55% of all sales. So we're looking at 250 to 500 segment, we look at the 5 to 750 segment, the 750 1 million segment, and the 1 million above segment. So when you're taking a look at that level going up, that's where all the transactions are at, and the majority, quite frankly, is in 38% of the sales for the 250 to 500 range. Now on the sub 250, 100 to 250 is 37%, and 0 to 100 is 8%. So you got a 45-55 split here. Obviously 250 and above is the greater share. So if prices, so if more homes are being sold in the greater share or the piece of the pie, that's going to drive your average price up as well too. So please keep that in mind. And again, that's where we're at with respect to the affordable housing, which I call sub 250 marketplace. Still has the least amount of inventory. If you look at the charts and statistics, the sales are decreasing at a faster pace in that segment because there's less properties in that market segment. Simple as that. Unsold inventory is at 4.3 months. That's up from 4.2 months from the April of this year, and it's up from 4.2 months year over year from May of 2018. So slight increase, which shows a little bit of inventory on the marketplace. And that's really kind of it. So again, we're not seeing a dramatic rise in home prices. We're seeing still showing trending slowing down. Yeah, and a little uptick from month to month, a little bit of a median increase in price, but we're still not seeing significant jumps. As a matter of fact, if you look at things from a macro perspective, it's still trending down. And just to kind of verify what's been said, Redfin, I guess, does their own, I guess you say, analysis as well too. So whether they are looking at their statistics, their personal market, or whether they're just reviewing what NAR puts out, I don't know. But Redfin basically said in May, home sales rose only 2.5% from the previous year. So they said, according to the company's analysis, the number of homes for sale at the end of the month rose by 2.5% year over year. This means May experienced the smallest annual increase in home supply within the last 8 months. Redfin chief economist says that recent surges in mortgage applications reflect heightened home buyer demand. A lack of inventory continues to prevent growth. So these guys are pretty much saying that they don't expect sales to increase just because the inventory is not there to support it, which seems to make sense. And whatever they said here, I'm just looking at some of the information here. Yeah, that's kind of it. Is just really, we can't have sales growth unless there's more inventory out there. So we're going to see a little bit of price fluctuation here and there because people may, pay a bit more just to get in that property range. We know that people are actually probably buying above their market peak just to go to the next segment to get homes. And we know that there are powers that be, Fannie Mae, Freddie Mac, FHA, etc., offering a lot of programs now to get people in to purchasing homes and help them extend their extend their availability to purchase homes by stretching, income via DTI and low down payment or no down payment through grants, etc. So we know that's going on, and we're going to see that subtly, increase in home value and median price, which we've seen right here. So there you go. To tag into that, though, shifting trend in housing investment, I think this is actually kind of important because the amount of homes purchased for investment has increased to its highest level in 20 years, according to CoreLogic. Very interesting. So we know that a lot of investing going on from small investors all the way to the institutional investors as well too, and we talk about this often. But however, CoreLogic did notice that this increase, the increase is really from smaller investors rather than large institutions. And basically, the current investing rate is about 11.3%. That's the highest rate since 1999. But they're seeing that the smaller investors are driving increases in investment activity as mom and pop investors grew from 48% of all investors that were purchasing homes back in 2013 to more than 60% of purchasers in 2018. That's a pretty that's a 12% increase. So obviously we see that going on here. And large investors, and I want to qualify that too. Small investors are really one home. Okay, it's simple as that. Maybe they look at maybe 1 to 10 homes, but again, mom and pa, I define mom and pa as doing one home, maybe 2 homes a year, if that. Large investors, those who purchase more than 101 homes, they nearly doubled their activity from 2013, but they've pulled back since the foreclosure crisis and now sit at 15% of the purchases. Now, having said that, that sort of plays into what's going on with our market here. So we see the smaller investors, the mom and pa's, growing. We see the institutionalized investors pulling back, and they, of course, did a lot of damage back after the last housing crisis. So when we hit the trough, we're coming out. They were buying, in this area right here because they were getting great deals. And even what they see, like the medium-sized investors, who they say purchase between 11 and 100 homes, they've seen their share steadily fall as well too. They've dropped their peak from 30% to 22.7%. So, again, I want to be clear here, and this is some comments on this. This is what shows what's going on here. So, why are there more mom and pa investors out there? Well, I call this, once again, the HGTV effect. All right, and that's home and garden television effect. I mean, listen, we all can, either in the evening time, daytime, weekends, you can sit in front of your TV, you can flip through the oodles of channels, and chances are you're going to see at least a couple of real estate shows on at any given time, any given hour of the day. Some of the networks that are out there, cater to this and have way more shows on average than other television shows, or other channels, I could say. So for me, there's more people in the marketplace who are involved in real estate investment today, and that's a cause effect, because when prices appreciate, so this is charted, and this can be verified. So when prices go up, people want to jump in the marketplace. We call that FOMO, fear of missing out, because they go, hey, prices are getting higher and higher. If I get in here and it keeps going up to here, I've now made that nice little gap, bit of appreciation or income, and I can sell and do whatever I want, whatever turns you on, I guess. But that they want to catch it on the way up. They don't want to catch it on the way down. So people are jumping in. So along with that factor, with the media, with all the sort of investment shows that are out there, I don't know where you live, but here locally where I live, every other week there is an investment, I'll call them dog and pony show, coming through our marketplace here. They stop, they do a couple of Southern County, they might do a Thursday presentation, 2 on Friday, 2 on Saturday, 2 on Sunday, 1 on Monday in our general area, and they kind of move it around the Bay Area where I live here in the Tampa area. So they advertise on the TV, late night they advertise on the radio, they advertise on Facebook. You get the Facebook thing. So these are all, this is always going on, and this increases when values increase, because that's what people want to see and hear. So people are looking to add income to their bottom line, looking to add and build wealth, and leave their jobs or augment their jobs or their current income right now. There's nothing wrong with that. But my point, though, is that you see a shift here. So as appreciation is going up and as property values are rising, we're seeing the mom and pop investors increase their activity, and we're seeing the institutional investors, or I call them pro investors. Listen, if you're doing what's the number here? If you're doing 10 to 10 plus homes a year, as far as I'm concerned, 10 to 100 or 100 above, you're a professional investor, or that's going to be your livelihood. So you know what you're doing. You've got a lot of experience. You're going to be doing things better than the mom and pa who were just learning and just trying to get out there on the weekend, so to speak. So when we see the mom and pa's raise and the institutional and professional investors drop, okay, that's a shift. These guys, they have analysis. They have professional people who are look at markets and trends and the whole bit. They're buying less because prices are up. So they're not going to make as much money flipping properties, fixing flipping, and they're not going to make as much money on a long-term hold, appreciation, whatever they're going to do. So they're buying less, whereas the mom and pa's buy more. So for me, that is an indication of where the market is headed. All right. So so more mom and pa want to get in that game now, and they're actually being sucked in by the fear of missing out and everything else in the environment that goes around, the social media and TV shows, to go, hey, get in the environment right now, do some real estate, fix and flip a property, make a bunch of money. So that's what goes on here. So I just wanted to, when the pros decrease their investment, that's a telltale sign that the market has hit a very high level of value, and they don't buy peak values when they're investing. They need to buy at discounts through different sources, but again, they don't go buy retail at peak value. Simple as that. So to me, that's your number one indicator going, the market's changing, and we're not seeing it at that point right now, because we're looking at the media and the hype going, again, sales are up 2.5% from the previous month. That's going to be spun as a great opportunity to get in the market. Now look, real estate's rebounding. I mean, I can just see what's going to happen over the next 48 hours and how the news is going to report this. So please, this is, to me, is a very, very important piece of information right here. All right, having said that, okay, I listened to a video today on CNBC, and they talked about the real estate sector leads the S&P. What they mean by that is performance in the S&P 500, and the top, so REITs, real estate investment trusts, are performing well, and the top performing REITs, believe it or not, are single family rental REITs, so real estate investment trusts, and their returns year to date are 34.65%. It's a pretty good return on your investment, isn't it? 34.65 year-to-date return. The next best one was warehouse. Others are infrastructure type REITs. But the point is, single-family rental is not the new, but it has been the best performing, hottest asset class out there. So again, REITs are performing well. Going back to the fact where I just spoke about having the institutional investors investing less because market's at its prime, you see. So they're buying less Markets are valued higher now, so the REITs are performing better. But I know that the real estate investment trusts and other hedge funds have amassed billions of dollars of capital they're waiting to deploy when the market changes. So again, please keep that in mind. There you go. And sort of bringing this together here, Freddie Mac announced his fixer-upper mortgages, and they have something they released this past week. It's called the Choice Renovation Loan Program, and saying it's available immediately through all their approved lending arms and lenders. Lenders have two paths for delivering the loan to Freddie. They can either wait until the renovations are complete, or for approved lenders, they can deliver the loan while work is ongoing if they're providing the oversight for the project. So the whole idea is that this is a new offering that allows people to purchase a home that needs repair, or allows existing homeowners to renovate without having to do a cash-out refi. So very, very interesting. So again, Freddie Mac, again, looking at this going, okay, let's see what's happening here. And going back to, let's look at the marketplace, where if we see sales are slowing down and people aren't buying as much anymore, they're being pushed up in segments. A lot of buyers, and when I say buyers, I'm not talking, this is not really designed for, as far as I'm concerned, for investor buyers. This is designed for average people, retail buyers, the normal population who just wants to live in a property but can't find a home that suits their needs or is cost effective. So what this is doing, it allows them to get a home that maybe that fits what they need in price range, knowing they have to do some work, and it's giving them some opportunity to fund the real estate rehab as well too, to fix that home up and they can live in it. So this is kind of like, I call this a retail rehab as far as I'm concerned. So I think we're going to see more and more people going down this path. Quite frankly, I can tell you based on some of the comments I see and the inquiries I get, more and more people who are out there looking for properties. I mean, the thought is, why do I need to pay premium? I still don't want to pay top market prices. Hey, I'm willing to look for something that may not quite be, the number one best property, but it's in my price range. I don't mind putting a little bit of sweat equity or some rehab into it if I can swing it. So this is just one loan by Freddie Mac. If you start talking to mortgage brokers, I mean, going to your banks and credit unions, they don't normally have a lot of choice with respect to rehab type loans. If you go to a broker, a mortgage, or a correspondent lender, you might find more, there's more play in those type of programs that are looking at the property opportunity there. So again, we're going to see more of this, again, based on the fact that where the market is. So if you can't buy or don't want to buy that premium price property, don't want to move up your market segment and pay more and stretch yourself, then this will be an alternative, and there are already more loans like this, and I'm sure there's more coming down. So realize that. As far as they're concerned, the renovation market has grown 50% since the Great Recession ended in 2009. Freddie Mac stated, and nearly 80% of the nation's 137 million homes are at least 20 years old, and 40% are at least 50 years old. So you start taking a look at that. So when your home is 20 years old, what's typically going to happen next? Well, your number one renovation is probably going to be a roof, right? Roofs are 25, 30-year shingles, so that's your next big renovation. So you got to think about that next few years. It may be outdated or out of style, so you probably want to update your kitchen or bathrooms. Those are the big ticket items for renovations. And people who want to grow their family and need more space, they're going to add on structure. They're going to add on square footage and rooms to the house as well too. So it's interesting that people are picking up on this. And again, it's all about, as I say, innovation. And if you start looking at the trends, the people who are out there working to supply products, services, loans, money, whatever, they're going to find ways to get into that marketplace and deliver what people need if they see opportunity. So again, I think this is good, but this goes to show you that more and more people are looking at this avenue to buy their home as opposed to the true retail marketplace. And I think this is a good thing. As I said before, I have ways that I can help you, and I look at everything distressed, and there are ways that you can go after properties like this, especially if you've got a loan that you're pre-approved with. It's going to make it a lot easier to put a deal together, etc. So that's good news for that. Just to sign off here, student debt, I guess you could say, hit another record high. It's $1.4 trillion in 2019. So realize that this is like the big three. The big three debt is mortgage, student loan, and auto loan and lease. And it looks like student loan has now overtaken auto loan and lease as the number 2 debt segment out there. Very interesting. The average student loan debt per borrower is about $35,000. and the Washington D.C. has the average amount of loan debt per student at almost 56,000, and South Dakota has the lowest average student loan debt at about 29,000. So there you go. So interesting to see that. Again, mortgage, student loan, auto loan, lease are your top three. And why this is interesting is because it's a concentration. So basically, they say about 14.4% of the population has student debt. So when you take a look at that number, it's 14, is almost 15% overwhelming. Not necessarily overwhelming, but it's the concentration. So student debt is concentrated in a specific age group, which I think we know where that age group is, most like the millennial generation, that have few assets. Student debt is concentrated in age groups that are struggling with credit card debt. So not only do you have student debt you're struggling with, but another debt's on top of that. And most importantly, student debt mostly impacts those in age groups who may want to buy a home, get married, or start a family. So when you hear this, it does affect real estate, and even though it's not a huge segment of the overall population, it affects a large segment that are looking to move on with their lives and create more economic stimulus by buying homes and things like that. And that's not happening. That's the number one drawback, as far as a lot of statistics show, that millennials just can't afford to do life things until that student debt's taken care of. So keep that in mind. Alrighty, so that's it for today. Want to do as much as I could in a short period of time, but the big news is obviously NAR releasing the fact that existing sales up 2.5% month over month, not year over year. Year over year they're down. So please don't get swayed by that and the media. All right. So again, thank you for all the likes, for the views, the comments. Please field questions. You can hit my email off the information section of the video. Send me a direct email. I'll get back to you. As I mentioned, I think I've gotten back to everybody as of now that I've got as far as who's emailed me. So we need to start communicating and getting into things. I'm prepared to do that. I'm prepared to make some contacts for you and help out here and there where I can. Please reach out to me regarding real estate, particularly real estate investment. For me, my focus really is the pre-foreclosure market. And if I go back to, this is a future discussion. I tell you guys I have lots of future discussions. I'm building a lot of videos and a lot of playlists that I want to release shortly. They just do take time to formulate and get out there. But when you take a look at the NAR statistic I mentioned earlier, that only 2% of all the transactions for May were distressed sales, and they're either real estate owned REOs or they're short sales, and short sales make up less than 1%. That means a couple things: that market isn't being serviced, and two, that there's a ton of opportunity there. So that's what my focus is. It's been that for a number of years now, even since the last housing crisis was our focus. But this is a renewed focus because I really believe that, well, if you go down that path, you can invest and make money. But I've noticed that I think there's a lot more, just trending here and what we talk about, like all these new loan programs and what sellers are looking for now. Buyers are now more willing to, and I don't call it a sacrifice. I think it's just you're willing to I guess say purchase a home for less and get a discount and offset that with maybe a little bit of sweat equity or rehab, cosmetic work, whatever you want to do to make the place yours. And that's a pretty good trade-off because I can prove to you very easily that the distressed property, median sales price is much different than a retail median sales price, and which seems to make sense clearly. So anyway, everybody, thank you for watching. Have a great weekend. Looks forward to speaking with you early next week. Take care.